Hello traders. The title of this video is Wave Trading Education Part 1. Alright, today is the 14th of June 2013 and we are starting this series of video called Wave Trading Education. This is part 1 of this series of video. The time in London is 7 minutes past 9 a.m. In New York, 7 minutes past 4 a.m. For those of you who are new to us, we are the GSTWSYS008 traders. Our website for Elliott Wave is 24elliottwaves.com. This is a short video, which is the first part of the series of video that we call Wave Trading Education. This is part 1. Alright, so we want to discuss what we need to know, how to trade Elliott Wave, okay, how to master the wave strategies. Alright. So the first thing that we are looking for when we are using the Elliott Wave principle is the market patterns. Alright, so talking about our guidelines, here we see, okay, we're on the yearly chart. Can you believe it? We're on the yearly chart, and it's still valid on the yearly chart. The wave principle is a fractal principle, valid on all time frames. 1 minute, 10 seconds for high frequency traders. Alright, 1 minute, 2 minutes, 3 minutes, you will see the wave principle still valid. It's a fractal principle. Alright, so though we are on a yearly chart, we can see that the guidelines that we follow: consolidation. The first wave must break a resistance level on the left hand side. The first wave must break above a consolidation level. What usually take place? There was a trend, and then there was a quiet market debating what to do next. During that time, during the consolidation period, though we say in theory, we have equal high and equal lows. During that time, a momentum is building, and slowly but gradually, either the bullish momentum or the bearish momentum will exceed, the other momentum, and we will see a breakout. Do not rush, be patient. And usually, the first wave will break the resistance level. As you can see here, something has happened here on this yearly chart. If you look carefully, pay attention. There was this tall candle here. Can you see on your chart? For 1 year, the price went up. And then there was a pullback, almost 70% with this 2 candle here on the yearly chart. And then the price ran up to this level, alright, and then pulled back. In fact, the price went all the way up to this level before pulling back here. So what was going to the mind of a lot of traders is that they count this single candle as the first wave, and they call this 2 candle here the second wave, and they call this move, in fact, that went all the way up here, alright, a third wave, and they call this one, a fourth wave, and they call this one here, alright, a fifth wave. Alright, that's what's happened. One thing I want traders to understand is that the first wave is the wave that will break the consolidation pattern, the market pattern. Now, sometimes there is a problem because traders count like this. They say 1, 2, 3, 4, 5. Say end of the fifth wave, which was also shorter than the third wave, providing more fuel for the bell to sell, and they sold it down. And trader will use their Fibonacci drawing tool, and they will highlight from the beginning of the trend. So from the beginning of the trend to the end of the fifth wave, the highest point of the motive wave. In this case, is the high of the third wave. That is the highest point of the motive wave. The motive wave is first wave, second wave, third wave, fifth wave. That's the motive wave. Normally, the high of the fifth wave is the highest point of the motive wave. But in this case, you can see that the fifth wave was shorter than the third wave. So the highest point of this motive wave is the highest point of the third wave. We need to move on fast. That's why I don't want to dwell too long on it. So after that, trader will highlight you want to know what traders are doing, the Elliott wave trader, they will highlight the 50% level, which is normal, it's a psychological price level, and they will also highlight the 61.8% level. What they are trying to do, they will be looking for opportunity to buy in this zone as the price is pulling back to this zone. But you have to understand, after the multi-wave, to complete the Elliott wave cycle, we must have a corrective wave. So the multi-wave plus the corrective phase, that's what is forming the Elliott wave cycle. But the mistake that traders are making here is that sometimes, all right, the corrective phase can be a flat correction, which means the price can, from this point, can go back above the high of the multi-wave. People will think that a new cycle has begun, but no, it's just a correction. Talking about a running flat correction, the price will go back above the high of the multi-wave, only to come back down big time. I will stop this video here, and we will continue in the next part of this video talking about wave trading education. This is a wave trading education part 1. I invite you to follow me in the next part of the video when we will continue this discussion about wave trading, and we will be talking about wave trading education part 2. See you in the next video. Thank you for watching, and we will speak to you very soon. We are the TSTWSYS008 traders.